RBI closes its NRI dollar window early. So is it a success or a policy U-turn? Just 9 days after saying there was no proposal to close the scheme early, the RBI changed its decision and announced an early closure. So why did it do so? Because Indian banks collected a massive $52.3 billion, that is roughly 4.6 lakh crore rupees from NRI deposits in just over 2 months. So was this an RBI policy U-turn, or did the scheme simply become more successful than expected? Let us understand the complete story in simple language. But before we do that, let me remind you Parimal and Gaurav are coming to Delhi NCR on this Sunday, that is 30th of August, for a workshop on financial freedom. So if you are living in Delhi and you haven't booked the seat yet, do so as few seats still remain. And Investyadnya is offering 60% discount on its model portfolios through the coupon code FREEDOM, FREEDOM. And we've just finished rebalancing our portfolios, so it's a very good time to get access to them. So what is an FCNRB deposit? FCNRB stands for Foreign Currency Non-Resident Bank Deposit. It is basically a fixed deposit meant for NRIs. Suppose an Indian working in the US has $10,000. Instead of converting those dollars into rupees, the person can deposit the money with an Indian bank in the form of dollars. What are the advantages? The advantages are the deposit remains in foreign currency, the NRI is protected from rupee depreciation, both principal and interest can be taken back abroad, and the interest is generally tax-free in India for eligible non-residents. So this is like a dollar fixed deposit offered by an Indian bank. But remember, the RBI has not closed formal FCNRB deposits. It is only closing the special forex swap facility attached to certain FCNRB deposits. So why did RBI launch this special facility in the first place? In June 2026, the rupee was under pressure because of global uncertainties and foreign capital outflows. India needed more dollars coming to the country. Therefore, on June 8th, the RBI introduced a special dollar-rupee swap facility. The idea was simple: encourage Indian banks to collect more dollars from NRIs. But banks faced a major problem. If a bank accepts a dollar deposit and converts the money into rupees for lending, it faces currency risk. For example, suppose a bank received dollars when $1 equals 90 rupees. After 5 years, if the dollar rises to rupees 100, the bank will need more rupees to repay the same number of dollars. To remove this risk, the RBI effectively told banks, give us the dollars today, we will give you rupees, and after 3 to 5 years, we will reverse the transaction at pre-decided terms. This protected banks from major currency fluctuations. Because the hedging costs came down, banks could offer attractive interest rates on eligible FCNR deposits and collect more NRI money. So how was the response? The response to all this was much bigger than expected. The original deadline for banks to collect eligible FCNR deposits was 30th of September 2026. But between June 8th and August 13 itself, FCNRB deposits brought in $52.3 billion. Overseas foreign currency borrowings brought in $2.805 billion, and external commercial borrowings contributed $1.741 billion. Therefore, the three facilities put together attracted approximately $56.85 billion, or more than 5 lakh crore rupees in just over 2 months. The RBI now expects the three facilities to attract at least $80 billion in total. That is why the RBI decided to advance the FCNRB deposit deadline from 30th September to August 31st. Banks can complete the related swap transactions with the RBI until September 11th. However, the other windows for external commercial borrowings and overseas bank borrowings will continue until 31st December 2026. So then why are people calling it a policy U-turn? At the RBI press conference on August 5th, Governor Sanjay Malhotra said, as of now, there is no proposal to close the scheme prematurely. But on August 14, just 9 days later, the RBI announced the early closure. Naturally, this raised questions about policy consistency. Banks and NRIs were planning their deposits based on September 30th deadline, and suddenly they had 1 month less. However, the RBI governor says this is not a U-turn. According to him, the important words were as of now. The situation was changing rapidly, dollar inflows were much stronger than expected, and the RBI took a fresh decision after looking at the latest data. He described the move as well thought out, calibrated, prudent, and data driven. So why doesn't the RBI want unlimited dollars? At the first glance, more dollars coming to India sound like completely positive. But there is a cost. When banks give dollars to RBI gives rupees to banks. Those additional rupees enter the Indian financial system. If too much money enters the banking system, it can reduce short-term interest rates, encourage excessive lending, and potentially create inflationary pressure. The RBI may then have to remove or sterilize this extra liquidity. This sterilization also has a cost. In simple language, the first few $1 billion are highly useful because they strengthen India's forex position. But after a certain point, every additional dollar provides less benefit while increasing the RBI's future cost and liability. So is this money completely free for India? No. These inflows strengthen India's forex exchange reserves today, but they are not permanent or free money. The NRI deposits remain liabilities for Indian banks. Under the swap agreement, RBI receives dollars today but also commits to returning those dollars when the transaction matures. So India gets a stronger dollar buffer now, but the RBI also creates a future obligation. This is another reason why the central bank may not want the facility to grow without any limit. So how does all of this impact the rupee? The larger dollar inflows can strengthen India's balance of payments and provide additional protection during the periods of global uncertainty. SBI research expects India to record a balance of payments surplus of around $50 billion in FY27, while the current account deficit may remain near 1% of the GDP. However, this does not mean that the rupee will automatically appreciate sharply. The RBI governor has clearly said that the exchange rate will remain market-driven. RBI's objective is mainly to prevent excessive currency volatility, sudden speculative attacks, and disorderly movement in the rupee. Therefore, these inflows provide the RBI with stronger safety cushion rather than guaranteeing a particular rupee-dollar level. So what does this mean for banks and NRIs? For banks, the early closure means they have limited time to collect NRI dollars under the special swap facility. This is why several banks are rushing to raise foreign currency funds before the deadline. For NRIs, there are 3 important points. First, regular FCNRB deposits are not being discontinued. Second, the existing deposits will continue at their contracted interest rates. Third, after the special swap window closes, banks may reduce the attractive rates being offered on new FCNR deposits because their currency hedging advantage will decline. However, NRIs should not invest only because of the deadline. They must compare the interest rates, lock-in period, premature withdrawal conditions, and taxation in their country of residence. So now, what is the final verdict? Was this a policy U-turn? From a communications perspective, the criticism is understandable. The RBI said there was no proposal for early closure and changed the deadline just 9 days later. That can create uncertainty for banks and depositors. But from an economic perspective, the RBI's decision has a logical explanation. The scheme collected $52.3 billion from FCNRB deposits alone, much faster than expected. The objective was largely achieved while the cost of absorbing additional dollars was beginning to increase. Therefore, this appears less like a policy failure and more like an early exit from an extremely successful temporary scheme. The real message is the RBI wanted dollars and received far more dollars far faster than expected. So what do you think? Was this a sensible data-driven decision, or should the RBI have honored its original September 30th deadline? Share your opinions in the comments below. Also, do let me know how are you finding this new voiceover format. If you found this video useful, like and share. Subscribe to be a part of the Yadnya family, and I'll see you in another one. Until then, happy investing from Ashwini.